Hi there. Welcome to Berman's Call. We are here to take your questions on both stocks and ETFs today, and you can reach us toll free at 1-855-326-6266, or you can email us at bermanscall@bnnbloomberg.ca. And Larry, of course, joining us in studio. It's good to have you in.
Well, it's good to have you here. It's our first time together.
It's our first time together, yes. So it's been an interesting year so far, even though it's only the second month of the year, particularly what we saw last week when it came to Anthropic releasing that new tool, the sell-off of software stocks. It really just goes to show how fragile some software stocks could be. Do you think?
Well, I think the debate in Silicon Valley and on Wall Street is how disruptive is this next wave of new technology going to be? I'll give you an example. At our firm, when we manage billions of dollars, we're looking at a new software with a bunch of AI agents that are literally going to replace what would be a dozen analysts that I would hire to scour stocks and come up with opinions on things. Wow. So, it's going to matter. But then I look at it and I say, is that AI agent tool going to replace a Bloomberg terminal? Let me use that as an example if I can. And so there's some disruption definitely coming, and then the market's debating right now what that means. There's an ETF, and I'm not sure we have a chart of it, but IGV trades in New York, and it's a basket of all these software players, Microsoft being the biggest down to some of the smaller ones. Mm-hmm. In a thing like CRM, so client relationship management software, and me as a company owner, am I going to build my own? Or am I just going to buy something that's out there? Because they talk about all this AI coding their own systems, right? So you're going to get some of that, but this is also measured in years and maybe decades before it really has an impact. We're invested. So here's the chart right here, if we can bring it up. But you can see the dramatic move here in the last few months relative to where that sector got to back when we were worried about max tariffs. But coming out of COVID, this sector, if you look at the peak market there and where we are today, the software sector for the last 5 years has really made money if you didn't get in at the right time. Right? So with every investment, timing's important. But I like it here way more than I liked it here.
That's fair. Good time to get in.
And I'm a buy low, sell high kind of guy. And while I recognize that if it's massively disruptive, which only the next 2 or 3 years will tell us, that we could get back to these lows in the sector. But right here, if you're not in, software is starting to look very interesting. We picked off a few names last week that we like in the sector that have been halved from where they were at their recent highs.
Okay, so looking ahead, we're going to switch gears a little bit as well because we've got U.S. employment numbers coming out this week. Canada's, of course, were last week. I'm curious your thoughts on that, but also in terms of what we're watching for with the U.S. numbers coming out this week, also a potential revision?
Yes, so once a year they go through the numbers and they look at actuals relative to what their models told us. So the biggest factor here is what they call the birth-death model. It's not births and deaths of people, it's births and deaths of companies. Right? So if there's a business permit given for a new retail store, they know that on average those type of stores employ 10 people. Mm-hmm. A year later, they only employed 6. So they estimated it was 10, and now they got to make an adjustment. Okay. Right? So that's kind of the process of what they do now. And they go back, and what a lot of the analysts think is we're going to lose about 800,000 or 900,000 jobs from what we actually got last year reported every month. Okay. Well, last year reported every month on total was only about 600,000 jobs. So if they now say, hey, you actually lost, not get 600, but you actually lost 200. So now we have the U.S. economy, according to President Trump, best ever, actually net lost jobs last year.
What do you think that's going to do to the markets?
Well, that's a good question, because last week we saw some data come in and it looked like the labor markets were weakening. Could have been a catalyst for some weakness last week. Mm-hmm. We do have a lot of economic momentum in the one big beautiful bill, and earnings are still okay. but we're starting to see a decay in the labor market. We're going to look at some charts in the educational part of the show.
Yeah, for sure. Okay, we're going to take a quick break right now. When we come back, we'll get to your phone calls and emails. And here's the number again. There's still time to give us a call with your questions on ETFs and large cap stocks. You can call or email us. We'll be right back. Hi there. Welcome back to Berman's Call. We are here, of course, with Larry Berman, and we're going to start taking your questions now. We've got an email coming in first. This one's from Stephen. It reads, when choosing an ETF, how important is the AUM and the trading volume?
So the second, I'd ask a follow-up question. Are you a trader or are you an investor? Because if you're an investor and you're buying it once and holding it for several years, it almost doesn't matter. You want to look at the company that's issuing it. If it's a Vanguard or BlackRock, any of the big ones, they're not going away. They'll be around for a long time. But an upcoming upstart ETF company, there's a viability where these things make a profit or the company goes out of business. So, you have to look at the firm overall. It's not necessarily about the ETF. But if you're a trader and there's not a lot of money in it and the bid-ask spread is, on a $20 ETF, you're paying 5 cents in and out, that's a far bigger cost if you're an active trader than the $10 you're going to pay your discount broker to trade it in your account. Okay. So you want to look at bid-ask spread. In theory, it's related to the size and liquidity. But if you have a new market, but it's trading the Canadian banks. Canadian banks, very deep market underlying. So it doesn't have to be a huge ETF because what's underneath it is very liquid. So it's a great question. There's a lot of different parts when you're thinking about which one's appropriate for you.
Okay, we're going to go to the phone lines. Andreas is calling in from Calgary with a question. Hi there. What's your question?
Hello to the both of you, and thank you for taking my call. Larry, I'm curious about your thoughts about the company Algoma Steel, ASTL. I'm United States and Canada. There's some tariff issues there. I'm also curious about how would Algoma perform against its competitors? Should the iron ore price revive once again, against Vale and Cleveland-Cliffs? Would you go with Algoma? At any rate, I value very much your opinion, and I'm just going to hang up and listen to what you have to say. Thank you so much.
Okay. Thanks so much for your question. Yes.
Yeah, I always like to look at a sector first. SLX is the U.S. ETF that covers the whole steel sector. And so you like to look at how is a stock trading relative to its sector. So right now, overall, I would say Algoma wouldn't be my top choice in the sector. But the sector looks really interesting right now. In other words, there are pressures from tariffs and other things. If we're closer to the end of the business cycle, a lot of these stocks are getting pretty cheap. Mm-hmm. So it's the sector's on my radar right now. I don't have any direct exposure right now, but it's interesting. Remember, I'm a buy low, sell high kind of guy. Yeah. And right now there's more weakness than not.
So then if Andreas, he was asking about the competition for Algoma Steel, I guess maybe if you say it's not your favorite in the sector, does it have some steep competition?
Well, there's a lot of names that have been doing a lot better. Algoma's been underperforming for a while. So you wonder and say, well, if the sector's been doing okay, but this is really not performing, do you really want to be there? And so I'm not doing the work and saying, hey, there's a turnaround story coming, right? So I like the steel sector. Short term, a little overbought. I'd be buying into pullbacks.
Okay. We're going to go to another caller now. Andrew is calling in from Toronto with a question. Hi there. What's your question?
Hi. Thanks for taking the call. My question's on ZWU, which, Larry's recommended a few times. And I'm looking at it as a partial replacement of some of the bonds in my portfolio. Obviously, it gives an extra yield. What I'm fussed about is how much extra risk am I taking on? And I'm looking at the history of ZWU. It seems to vary quite a bit. And I'm wondering if I might be better off just buying TELUS or BCE and getting that dividend and taking their variability. I'll hang up and listen to the answer. Thanks very much.
Thank you. What do you think of that strategy?
99 times out of 100, I'm going to say, don't try to pick one or two winners, diversify. So I like ZWU. Again, you get all the telcos, you get all the utilities, you get all the pipelines. The variability in this is the poor performance of the telcos in recent years. And we know the story of BC and others that have struggled in the market here. But you've got the benefit of potentially pipelines and falling interest rates, utilities do well. So I'd much rather have a diversified exposure more than anything else. And so I wouldn't try to pick your TELUS or BCE here. I would say go with this. It's tax efficient. You get a lot of capital gains treatment coming off the portfolio. So if you're in a taxable account, it's even better that way than your pure dividend. Is it different than a bond? That was the original question. It's equity risk. So I wouldn't take my very safe bank bond and replace it with this because it's a better return.
Right.
But I would if you can handle the volatility of that return. So if you're comfortable, not too worried too much about this, you've got a great group of companies, diversified basket. A lot of them, like in the telco space, have already corrected in a significant way. And so I think the timing is pretty decent here for ZWU.
Okay, we're going to go back to the phone lines now. Walter's calling in from Fort Erie with a question. Hi, Walter.
I'd like to know your opinion on Thomson Reuters. It's dropped considerably in the last 6 months or so. Is it a hold or sell it? Thank you.
Okay, thank you. Yeah, Thomson Reuters, a rough week last week. Thoughts?
Once upon a time, I worked for them in Boston years ago, but that was a long time ago. Listen, it's a falling knife at the moment. Would you sell it here? Again, I'm the kind of guy, when it gets expensive, I don't want to own it.
Yeah.
When it's selling off like this and panicking, my eyes go like this and I say, opportunity. I don't see it yet in terms of the opportunity. Would I sell it here? And the answer is I'd have to do a lot more work on the name to try to figure it out. It's not one in my universe that we normally follow and cover. So it's not one that I'm that familiar with, and I would have to do a deeper dive. Right now, just looking at the chart and knowing a bit of what's causing it, I would say just leave it alone for now and let it settle. You get a good 3 to 6 to 12 months of, okay, it stopped going down and it's starting to find a level. Then you start to get interested in it from a new buy perspective. I don't know yet if it's too late to sell it. I don't know the answer. Sorry.
Okay, we're going to go to an email now. This one coming in from Dawood, and it reads, "Hi, Mr. Berman. Recently, the Bitcoin price has gone up over 2%, but the Bitcoin ETFs like IBIT and others have fallen more than 5%. Could you explain, please?"
Yeah, so Bitcoin trades 24/7. So on a Friday, the IBIT closes at 4 o'clock. On the weekend, it's trading. So that weekend price is not necessarily reflected in Monday morning's opening. So Monday, it might be up 2%, and the ETF could be down because of what happened over the weekend. I'm guessing that's the situation here, because I didn't look at the timestamp, but when that email came in. But it's a great question, but it's a 24/7 market as opposed to the stock market, which just trades during business hours.
Okay. Another email now, this one coming in from Kirk, and it reads, "I'm wondering the benefits of purchasing a CDR, which is Canadian Depository Receipts, as opposed to the actual USD stock. Do they provide currency hedging? Does it change the tax portion on the dividends? Looking to purchase MSFT and wondering the best direction to go." So a couple questions
some
there.
of the benefits are, it does hedge the currency. There's a cost in hedging that currency, so that's embedded in the return you're going to get. But that really is no different than owning it in the foreign currency, right? Because you're getting that mark-to-market currency change. So you're getting that hedge, but it's costing you the equivalent today about 1.5% a year in terms of your returns. There's no tax benefit at all. Can you imagine they create an instrument that trades in Canada and all of a sudden CRA is giving you a tax benefit of that dividend where that tax has been paid in the US? That's never going to happen. well, never say never. Some financial engineer might figure it out one day.
Most
but
likely
that's
not going to happen. Yeah.
And but then you can be in fractional shares. So if you have a share that you can't afford to buy enough of a full lot, where it trades for hundreds of dollars in the US per share, the CDRs often break that down. So there's a cheaper entry point for the average investor. So there's a lot of benefits to it, but there are some considerations. There's no tax benefit at all. You'll save money if you're an active trader on the currency side of things.
Okay. All right, another email now. This one coming in from Wade, and it says, can you recommend an ETF for unsheltered long-term growth in Canada with no dividends or tax bill every year, or should I just buy Berkshire Hathaway?
Yeah, so good question. So, a U.S. company that doesn't pay a dividend, you're going to get that compounding without that withholding tax. Global X ETFs have a series of ETFs that are in a corporate class, and they're done with a total return swap. So what does that mean? It basically means that there's favorable tax treatment and because there's no annual distribution. So you can get exposure to markets in Europe, the exposure to markets in the US without having that annual distribution. So two, it's got a corporate class and it's done with a total return swap. So you're getting the total return of the index less the fees, but you're getting it a little bit more tax efficient. So I would look at Global X, and they've got a whole suite of them, might be appropriate.
Okay, we've got time, I believe, for just one last question here. Another email coming from Tom, and it says, hi, Larry, I'm 2 years from retirement. I think my RRSP is big enough. I'm almost 100% in equities. Can you recommend some fixed income ETFs to lower the risk in my portfolio and provide monthly cash?
So here's the thing. So ETFs and an index, short-term corporate bond index, XSB or the BMO version of that. So there's several out there. This gives you kind of a laddered approach to fixed income. But with just a little bit of work, you can go look through those ETFs, see the holdings, and actually structure your own laddered portfolio to meet your own needs. So say in year one, you're retired and you think you're going to need $50,000. You buy $50,000 of a 1 year corporate and you get that bond, they're high quality, and you're not paying the cost of the ETF. And for the average person, that's not a huge lift to actually do. Right. So I really like that for people who are asking a question like this and willing to do a little bit of work. There are a lot of ETFs for the job, and go have a look at some of those short-term corporate ETFs might do the trick.
Okay, we'll take another quick break right now, but coming up, today's educational segment is right after the break. Stay with us.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call, and we are here with Larry Berman in studio. It's time for Larry's educational segment. So Larry, take it away.
Yeah, so last year we started talking about the weakness in the labor market, and we were worried about the end of the business cycle coming. So the end of the business cycle, the last thing to drop is the employment situation. We had the Federal Reserve talking, they paused their rate cuts. They're worried about inflation, but at the same time with the dual mandate, they are, balanced. Of late, they're saying the labor market's a bit better. I look at the numbers and I shake my head because the labor market is structurally very weak. So we got a few chart updates last week. First one we're going to look at is the JOLTS data. So this is the job opening loss turnover survey, and this is job openings. And we've seen a pretty significant decline in the availability of jobs. Now, compared to where we were in past cycles, I get the economy's bigger today than it was. And this is a real anomaly around COVID. So you have a lot of charts related to labor, and you have these crazy looking things because of the shutdown and reopening and what that did to the labor picture. If you were to clear all these things and really try to smooth this out, you'd still say there's still a lot of job openings. But what we're seeing now with the way immigration's going and some of those policies, the size of the labor force is actually not going to grow that much anymore. Artificial intelligence obviously is going to have an impact here too. When we look at what companies do, so companies say, okay, we have 6 or 7 million jobs available, but they're not really laying people off. The next chart here is the continuing claims, the initial claims. So this is the first time someone gets laid off. They made an application for employment benefits. These historically are extremely low numbers relative to where these things were in past cycles. Okay, so 200, low 200s, very benign. So companies are fewer jobs available. They're not hiring as much. Last year, again, only about 600,000 jobs. We get the annual revision, and it looks like we actually didn't grow any jobs last year. We actually probably lost jobs. But still, nobody's laying anybody off because it's so hard to find qualified workers. Why? We have this massive skills mismatch. The jobs of the future. So you imagine someone who's gone to school like me, and I'm a financial analyst, and all of a sudden a computer is going to replace my function. Where am I going to get that next job, right? So you're seeing a lot of that in terms of, if I was a coder, I could get a job at that new AI company creating that software, perhaps, right, unless a computer is going to write that one day too, and the coders might be challenged. The last chart I want to look at here on the labor side is the continuing claims. So this is once you've been laid off, how long have you been laid off? And this number's gotten better. So when the Fed says things are improving here, it's this last little thing that started to downtick, meaning people who have been laid off are starting to find work and continuing claims are coming down. So that's good. Here's where I'm looking at it from a market perspective. 2 charts here, 2 ETFs I want to look at. RTH, retail holders. It's a market cap weighted ETF where the big names are the ones you would imagine, Walmart, Home Depot, Costco, all those. This ETF, ripping, very, very strong. So retail stocks are doing very, very well. When this starts to falter, the consumer's starting to falter because these companies are starting to tell us that it's no longer that top cohort of earners that are continuing to spend. The second one is RSPD, and this is equal weight retail. Keep these ETFs on your radar. Don't go out and buy them. These are warning signs for us. If we start to see these fail and roll over, tells you the labor market is starting to turn and consumer stocks and the rest of the market are going with it.
All right. Well, we're going to have to leave it there, but really great educational segment. Thanks so much for coming in. And if you'd like to follow Larry online, you've got options from YouTube to LinkedIn. Here is how you can follow him. And that's it for us on today's show. You can join us for Berman's Call Mondays at 3 p.m. Eastern, 12 noon Pacific. Stay with us. The close is coming up next.